Okay, let's dive into this. Welcome to today's explainer. If you've ever stopped to wonder how the actual intricate gears of global trade keep turning day in and day out, well, you are in exactly the right place. We're looking deep into the mechanics of global currency today, how nations trade, how those currencies are really valued, and the hidden forces constantly driving the global economy. Let's get right into the sources.
Here's our roadmap for the day. We'll kick things off with a welcome to the Forex market, dig into the mechanics of demand and supply, figure out how exchange rates are actually determined, compare fixed versus flexible systems, and finally, wrap up with the key factors that influence these rates. Simple enough, right?
All right, Section 1, welcome to the Forex market. So at its absolute core, the foreign exchange market, which we almost always just call Forex, is the worldwide network where national currencies are basically swapped for one another. And you'll notice our source text helpfully highlights the Hindi terminology here too, Videshi Mudra Bajar. Now, it's really important to remember this isn't some giant physical building you can go visit. It's a massive, interconnected global system driven by commercial banks, brokers, dealers, and national monetary authorities. They're the ones constantly moving this money around the globe 24/7.
But here's the thing. This market isn't just about day traders trying to turn a quick profit. It is literally the vital engine that smooths out all global transactions. First off, it transfers purchasing power internationally. That's what allows a business in, say, New York, to actually pay a supplier in Tokyo. Second, it provides crucial short-term credit to importers, which just keeps the flow of goods and services moving across borders without a hitch. And third, this is a big one, because exchange rates are always fluctuating, the Forex market offers hedging services. Basically, it allows companies and governments to protect themselves against the risk of massive, unexpected losses from those shifting rates. It's kind of like an insurance policy.
Let's actually anchor this with a super concrete mathematical example straight from our source text. So if we have to pay 50 rupees to acquire $1, the exchange rate is simply 50 rupees per dollar. Boom, that's it. It is literally just the price of one currency expressed in terms of another currency. This one simple ratio is the magic number that links the economies of different countries and makes international cost comparisons even possible.
Moving right along to Section 2, Mechanics of Demand and Supply.
Now you might be wondering, why do people in a home country actually demand foreign exchange in the first place? Well, it's driven by a few key everyday actions. First and foremost, when we want to buy goods and services from other countries, meaning when we import stuff, we obviously need their foreign currency to pay for it. Secondly, if citizens are sending gifts or financial transfers abroad to their family or friends, they need foreign currency to do that. And finally, if individuals or firms decide they want to invest in the financial assets of another country, they have to have that foreign exchange to make the transaction happen.
So, that brings us to the absolutely crucial rule of demand. And there is a strict inverse relationship here. Think about it. If the price of foreign exchange rises, meaning foreign currency suddenly becomes much more expensive to buy, while the cost of purchasing imported goods goes way up in terms of your local currency. Because those imports are now significantly pricier, people naturally buy fewer of them. And consequently, the overall demand for foreign exchange drops. Makes total sense, right?
Okay, let's flip that and look at the supply side. How does foreign currency actually flow into the home country? Well, it's the exact mirror image of what we just talked about. When a country exports goods, foreigners have to buy them, which automatically injects their foreign currency into the domestic economy. Similarly, when foreigners send gifts or transfers inward, or when foreign investors say, hey, I want to buy assets located in this home country, they bring their foreign currency right along with them, which naturally increases the overall supply.
And the rule of supply operates on a direct relationship. Think of it kind of like this. A rise in the price of foreign exchange essentially puts domestic goods on sale for foreigners who are holding a stronger currency, like the US dollar. Because their dollars suddenly buy way more of the local currency, the local goods become incredibly cheap for them. This massively boosts exports, and as a direct result, drastically increases the supply of foreign exchange flowing back into the country.
All right, Section 3, Determining the Exchange Rate.
So different countries actually use totally different methods to determine these rates, and they generally fall into three main buckets. First up, there's the flexible exchange rate, which is also known as a floating rate. Second, there is the fixed exchange rate. And third, there is this sort of hybrid model known as the managed floating exchange rate.
Let's zoom in on that third one for a second, because it is highly relevant in today's world. A managed floating exchange rate is actually often referred to as dirty floating, which is just a great term. It's a really pragmatic mixture of the flexible and fixed systems. In this setup, the everyday market forces of supply and demand are totally allowed to operate. But central banks actively intervene, buying and selling foreign currencies in the background to intentionally moderate exchange rate movements whenever they feel like the volatility is just getting a bit too crazy or maybe going against their broader economic goals.
Which leads us perfectly into Section 4, fixed versus flexible rates.
When we compare these two extremes head-to-head, the contrast is honestly pretty stark. In a fixed exchange rate system, the government steps in and artificially sets the exchange rate at a very specific level. When they actively change this rate to make their domestic currency cheaper, it's called devaluation. When they intentionally make it costlier, it's called revaluation. On the flip side, a completely flexible system is determined entirely by market demand and supply. The central banks just completely step back. There is absolutely zero intervention in the foreign exchange market from them.
So you're probably asking, why would a government choose a flexible rate over a fixed one? Well, breaking down the merits, a flexible system is actually incredibly liberating for a government. See, in a fixed system, if there's a deficit in the balance of payments, the government literally has to drain its official foreign reserves to intervene and prop up that artificial rate. And if those reserves run low, panic and speculation usually follow. But a flexible rate frees governments from having to stockpile those massive official reserves. Movements in the exchange rate just automatically, naturally take care of surpluses and deficits in the balance of payments. And perhaps even more importantly, it gives countries true independence in conducting their own monetary policies, completely free from the exhausting burden of constantly defending a pegged rate.
Finally, we arrive at Section 5, key factors influencing rates.
When you really synthesize all this source material here, you quickly realize just how unbelievably interconnected the global economy truly is. Exchange rates are definitely not set in a vacuum. They are constantly being pushed and pulled by these massive, deep macroeconomic forces. We're talking about differentials in inflation and interest rates between countries. We're looking at things like current account deficits, the heavy weight of public debt, the terms of trade, and even broader realities like overall political and economic stability, the looming threat of recession, and of course, pure market speculation. Every single one of these factors exerts serious pressure on that exact demand and supply tug-of-war we discussed earlier.
And beyond just the economic theory, we have to look at actual real-world disruptors. As our source text specifically points out, massive external shocks can just abruptly alter these rates out of nowhere. For example, severe supply chain disruptions, like the massive ones we've seen in view of the Russia conflict, they can immediately impact inflation and trade terms globally. Additionally, heavy foreign fund outflows, which is basically when investors get spooked and rapidly pull their capital out of a country due to some sort of instability, that will aggressively and violently shift the supply and demand curve practically overnight.
So, we've covered the mechanics, the different government systems, and the short-term shocks. But I want to leave you with this final, provocative question drawn straight from our text's conclusion. What determines exchange rates in the long run? I mean, once the daily speculations, the sudden central bank interventions, and all those immediate supply chain shocks finally settle down, what is the ultimate fundamental anchor of a currency's true value over the span of decades? It is a truly fascinating question to ponder as you continue exploring the ever-shifting landscape of global finance. Thank you so much for joining me for this explainer, and keep questioning the mechanics of the world around you.